Go.
Okay, hello everyone. I'm coming to you from my truck at a medical clinic where I'm trying to help my wife out here today. So thanks for being flexible. Otherwise, I'd be there in the office with you. Um, okay, I thought I would talk with you a little bit about non-QM products because I'm doing a loan right now. It's $1.7 million new build. The customer is self-employed, and maybe we should talk about self-employed income for a few minutes. How many of you have had an intimate working knowledge with a self-employed borrower? Is that the right way to state that? How many of you have worked with self-employed borrowers and gained knowledge about how financing works with business owners or self-employed people? What's that?
I said, or been a self-employed borrower.
Or yep. Anyone?
I
Does
think
anyone
all.
have? Everyone? Okay.
Yep.
So who's had a bad experience? Any bad experiences at all with that? No? Okay. So I have been yep. Okay. So, and I just literally hung up the phone too with a self-employed borrower. So with self-employed borrowers, one thing that you want to keep in mind is banks and self-employed people have never been the bestest of buddies. It's been an ongoing there's been an ongoing conflict between self-employed borrowers and banks because self-employed borrowers do the smart thing and they tax shelter usually their money, and the banks do not look at that as income if it's being tax sheltered. And so what often happens is self-employed borrowers make way more money than what the banks will qualify them for. Good example, earlier in 2022, I closed another large home purchase for a self-employed borrower who brought home about $30,000 a month. But when I ran his tax returns through Fannie Mae's self-employed income calculator, which is the calculator that most banks and credit unions use. It's just a standard in the industry. When I ran his income through, we were only able to count about $4,000 a month on paper. And the guy was under contract on an $850,000 home purchase while putting 30 grand in his bank every month for the last 18 years. So that's the ongoing conflict between business owners and banks. And back in the late 90s, there were mortgage loan products that came out to solve some of this problem by offering self-employed borrowers a workaround so that they could not really prove any income, because when you're making, like this gentleman that I was working with, when you're making $30,000 a month, and we can only count 4,000, I mean, who's to say he's not really making 30? So, so there were loan products that came out in the late 90s to solve some of this problem, which allowed self-employed borrowers to just write down an income figure on a mortgage loan application, which the banks would just roll with without validating or verifying any of it, as long as they had a credit score that qualified. So that was one bank product that came out, bank loan product that came out. The second one was a bank stated product. And what that allowed the self-employed borrower to do was produce 12 to 24 months of bank statements. So in the case of this guy that I worked with earlier last year, we could look and see if he was depositing $30,000 a month. And then we were able to use that instead. Now the trade-off has always been on the interest rate. So these loans were offered back in the 90s and early 2000s to solve the dilemma for self-employed borrowers, but the trade-off was higher interest rates probably higher closing costs, and that's how the banks hedge themselves or protect themselves against the risk. And so what ended up happening is those loans snowballed into subprime loans. Does everyone here on the call know what a subprime mortgage was or has heard that term?
Amanda's shaking her head no.
Not really.
Jared's
Yeah.
saying no.
I
So-
don't know.
Okay, so subprime loans were basically riskier alternative mortgage loan products. So they weren't for your Coke industry salaried employee that's been there 5 years, has an 800 credit score and 20% down. They fell into a more riskier classification that was eventually called subprime, because it was sub or below the traditional mortgage loan products available to home buyers. But it got out of control. And what ended up happening in the crash of 2008, the housing crash and the banking crash, really, of 2008, was that those products started becoming available to everyone. So everyone started coming in with low credit and no money down and not having to prove any of the income they stated on the application. It just got heavily abused and out of control, and it eventually wrecked the banking industry. Bad. I mean, it was bad. So now that we're on the other side of 2008, after the housing market has had a chance to recover and revive itself along with the banking industry, we now have those loan products, well, at least one of the two of those loan products back with a safety belt, though. So it's not as easy as it was back then, but those loans are now available to home buyers. And that's how I closed the loan earlier last year. It's how I'm doing this larger $1.7 million purchase with this buyer in Florida. I'm basically taking her bank statements and using the deposits from her business and using that to average out a monthly income figure and get her qualified. And in fact, today we think we are right there on the threshold of getting her qualified using the bank data program for $1.7 million purchase. So she would never qualify for a jumbo loan, conventional jumbo loan, using tax returns. So anyhow, they're back, they're available. Her interest rate's probably going to be 9%, 8.75, 9%. The guy that I closed last year, when rates were at 4%, I closed him at 7.25. He took a 7.25 interest rate because on the bank stated program, I was able to show about $18,000 a month instead of $4,000 a month when we were using tax returns. So he had to sacrifice the interest rate for home ownership. So we closed his deal and he's in his house. And now everyone's rate, it's practically at 7. Anyway, so, well, it's definitely touched up there. So anyhow, those are called, so instead of having the term subprime, those are now called non-QM loan products. They're non-qualified mortgages, meaning they don't qualify for being insured by traditional mortgage sponsors like Fannie Mae, Freddie Mac, that sort of thing. So non-qualified mortgages.
What is the down payment usually for something?
If you have good enough credit, the minimum down payment is 10%. And that's another feature of these types of loans, that where the risk threshold is balanced out, is it requires a larger down payment. You can't get 5% down or 3% down. or anything like that, like you can with conventional FHA.
So once they go into the jumbo size loan, so what, I guess you can explain that to people a little bit. What does a jumbo loan like threshold, like where does that be?
It's a great question. So when we're dealing with regular, traditional, conventional mortgages, conventional home loans have a loan limit. So once you reach the threshold of about I don't have it in front of me. I think right now, conventional thresholds in the 600,000 somewhere.
And that's for our market.
That's for our market. Yeah. Cause it's varies based on market, because home prices in California are different than home prices in Wichita, Kansas.
Go wide in LA for 600.
Yep. And those are finance limits. You could buy a $2 million home, put $1.5 million down, and still do a conventional loan, because the financed amount falls below that $600,000 threshold for our market. But if someone's buying a $1.5 million home and putting $250,000 down, it will not qualify for a conventional home loan. So we have to take it through what's called a jumbo home loan, which that's a more riskier loan. You kind of have three tiers in the non-government mortgage world. You have conventional, that most people you work with get. Then you have your upper end home buyers that are buying $1 million plus homes that usually fall into the jumbo. So the conventional, less risky. Jumbo loans, more risky, because if they go into foreclosure, it's harder to sell $1.5 million home out of foreclosure in Wichita than it is to sell a $200,000 home out of foreclosure in Wichita. So the jumbo loans are more risky, but the interest rates are still good. But they do require 10% down on a jumbo loan. That's the minimum down payment. And then your next level of risk is the non-qualified mortgages I'm talking about. It's the most risky tier, and there is no loan limit. There's no jumbo versus conventional. It is a capped out maximum loan limit of I believe, $2 million. So there is a threshold, but it's just $2 million and below. So if it's $100,000 home purchase, 200,000, 1.7, like the one I'm doing, doesn't matter. It's all a non-qualified mortgage loan product, because it's the most risky mortgage loan you can get on the market today. And it's heavily utilized by self-employed borrowers who usually make more money, so they can afford 10% down payments and 8% and 9% interest rates. So
that interest rate sounds, I mean, especially like you've done a loan like this for David and I on an investment property, and we just look at it and it's like, if we're making more than what the interest rate is, then it's still a good investment for us.
It's a good investment. That's a great way to put it.
You're going to have to look at, I mean, I guess wrap your head around that, even just as a consumer. I mean, if you're in a market that's appreciating or things like that, or it's cheap, but they're going to be renting, because those prices are going to be higher than what a mortgage rate would be. I mean, that's why they would actually spend the extra interest rate. And
you should be telling your buyers right now, it doesn't matter if the rates are 4%, 7%, or 18%. If you can make a return on your investment, it's worth it. It's a numbers thing, right? If you can pay 18%
rent and things like that, and that you're going to have an upswing for potential profitability later. I mean,
yep, absolutely. That's a great point. But there's a lot to know about those loans. Now, the loan that I did for you and David on that investment property, that's not even in the non-QM space. That's hard money altogether. So that's a whole nother, risk category, and it's only for investment properties. So I can't even offer it to a homeowner anyway. So for a primary residence, it's more of a business loan.
Hey, okay, I have two questions.
Yep.
How long do they need to be in business? And then the second part is when you're verifying income, does it need to go like into an LLC, or can they just, I mean, what if they're just having money coming in? They can't just be just money coming in. Or how's that work?
Yeah, it's great. That's a great question. the best way to set a self-employed borrower up for success with the bank is they got to have 2 years of self-employment. And by 2 years, I mean, they need to have 2 tax return years filed. And they need to have 24 months of work history doing that particular type of job.
I thought this was for people that didn't file their taxes though.
That's different.
Nope. You still have to file your taxes. Any kind of mortgage loan product for a primary home purchase has to have tax returns, always have to be current if you're buying a primary residence, no matter what. That's just straight across the board.
Okay, so this was like for truck drivers. I think we talked about this before. Truck driver, I think you mentioned a guy that was showing like making 40 grand, but he actually made 100 in his income.
Yep. This would be a good program for a person like that. But if they're self-employed, it means that they 1099 themselves, or they have a corporation like a C Corp or an S Corp. So they have a business and it's either an LLC or it's a C Corp or S Corp, or they're just a sole proprietor. They haven't even started a legal entity like that. Maybe it's a freelancer that does graphic design. They just pay themselves through Venmo. They make $50,000 a year, but they don't need to start an LLC because there's no reason for that.
Right.
There's no reason to start an LLC, but they still have to have 2 years of history, and they have to have 2 tax return years filed. And we use the numbers on those 2 tax return years to average the income. Bank statement deposits for their business instead of using tax returns, but they still have to be current on their tax returns, even if we're not using them for income. Does that make sense?
Yeah.
Kelly, have any questions about any of? No. Yeah.
Anyone?
David, anything?
Nope. I watched.
It's real tricky because a lot of self-employed borrowers, when they hear that all they need is 2 years of self-employment, they'll think in terms of, oh, I'll just go get 2 years then under my belt and I'll call you back, Chris. And I have to tell them, just because you do that, it doesn't mean that in 2 years from now, you'll qualify for the home you want to buy, because you might write all of your money off. We might get 2 years down the road. You might be making $30,000 a month and we can only show $4,000 on paper. You're not going to be able to buy the house you want. So just because a self-employed borrower, gets a 2-year game plan together, checks off all the boxes, gets 2 years of tax returns underneath them, and does it all right, still doesn't mean they'll qualify for the home they ultimately want to purchase. They might not even qualify on the bank stated program I'm talking about here.
Well,
So it's just a conversation that you got to have with self-employed borrowers to help them understand how banking works and why self-employed borrowers and banks have never been the bestest of friends, because it's just
us as well, because their interest rate is higher.
Yep. Say that again.
But they might wind up qualifying for less anyway because the interest rate's higher. So their debt to
Yeah. Right. Yeah. That's exactly right. Yep. But just know those products are available. If you have a conversation with a self-employed borrower that says they tried to get qualified, the bank wouldn't approve them for enough, this is your moment to remember the call with Chris and go, you know what? There might be a product that can get where you can get qualified for more than the bank you tried to work with previously.
Or if they're trying to buy investment properties and haven't done their taxes, then that's still something that fourth tier that
Yeah.
tap into. So they don't have to abide by all the rules. They're going to pay the higher fees, higher rates, but there's still products for them and people will do it.
We'll let's try to shoot for that next week. We'll talk about hard money loans and just compare it with these riskier categories of mortgage loan products.
Okay.
It'd be nice if I had a whiteboard of some kind to draw on, so I could do some illustrations for you guys.
There's
help you wrap your head around this a little bit more.
Yeah, there's a whiteboard feature now. So as long as you're in front of your, I think, desktop, you can probably do it. We'll mess with it. We can figure it out.
Yep. Or maybe I just need to stay in my office, because within my office, I can zoom in on my